Today, I want to talk to you guys about the 5 most important mortgage rules to know.
You roll the dice to move your token, doubles gets another turn, and the first player to reach the end wins.
Now, these rules are very much pertaining to the pricing of your loan, how expensive or how inexpensive the loan is in terms of the interest rate that you get and your closing costs. But this is going to be a sort of behind the scenes look at mortgage.
You presume to criticize the great Oz, you ungrateful creatures.
And that's one of my goals with this channel, is to help you guys know more about mortgage. I was a teacher for 17 years. I taught music and I love teaching. So I want to help you guys know more. Let's get right into it. Number 1 is your credit score. Now, voila, that's like a big no-brainer, right? But the credit score in this particular aspect, and all of these 5 pillars that I'm going to talk to you about, are pertaining to something in mortgage that we call LLPAs, loan level pricing adjustments. What are LLPAs? LLPAs are essentially big determining factors that lenders use to decide how expensive or how inexpensive your loan is. And this is because loans, mortgages, and so forth are based upon risk. And usually, as we say in investing, the higher the risk, the higher the reward, generally speaking.
Did you see the memo about that?
So lenders, if they see that there's a lot of higher risk factors in a specific loan file, usually that's going to correspond to a higher interest rate, higher payments, higher requirement for more down, maybe more reserve funds, versus the opposite. If a loan file has these pillars involved and they're excellent, right? For example, in this case, if your credit score is above a 740, then that would equate to potentially a much better priced loan. I'm going to give my opinion on these ones, my professional opinion. Keep in mind that these are just designed to help you guys, because many lenders and loan officers out there, unfortunately, in our industry, may be incentivized to talk you into something that's not necessarily good for your long-term financial success.
Well, reason for the call today, John, is something just came across my desk, John. It is perhaps the best thing I've seen in the last 6 months.
And in which case it could put you at high risk of default or getting into debt and so forth. So we're going to go through that quickly here as you go through the video. But number 1 is your credit score. Now, the rule that I want to set in place here is 580 or higher. If you have a credit score of lower than 580, is it theoretically possible that you can get a home loan? Yes, it is. It's theoretically possible. That is to say, it's not impossible. However, I'm going to give a big red flag there. I want to plant that red flag.
5 to 114 and a red flag warning.
And the reason why is because even though it's theoretically possible for you to potentially get a home loan with a credit score lower than 580, it may not be in your best interest. Why is that? Number 1 is price, because that loan is going to be more expensive because the lender is going to see that it's high risk. But even worse than that potentially is the gambit a lender is going to put you through when you have that kind of a score. In mortgage, we have something called automated underwriting. Now, in automated underwriting, there's at least a couple different outcomes you can get. When I take your loan application, I run it through automated underwriting. Let's say it's through Fannie Mae. I could potentially, and what I want to happen is to have them come back and say, approve eligible. However, if you have a credit score lower than 580, the likelihood, the probability that that is going to come back as an approve eligible is low. And if it doesn't, it could come back with something called a refer. Now, a refer doesn't necessarily mean that you can't get a loan. It just means that now you have to go through a secondary set of underwriting standards in order to get approved. This is kind of like if you are coming back from another country and you go through customs and they make you go through secondary customs. So they're checking your stuff, they're asking questions. Did you bring back any fruits or vegetables, whatever?
How long were you out of the country?
You say no, and for some reason you're flagged. And they say, oh, please step over here, go to this room. Now you've got to sit there for an hour, 2 hours, 3 hours, 4 hours, and they're just going to gruel you on everything. This is what can happen if you're trying to get a loan with a credit score lower than 580. In many, many cases, I don't recommend it. Now, again, there's going to be loan officers there that are going to disagree with me. Oh, no, Aaron, it's so important to buy now. They got to buy now. I say, no, that's not true. Every person's situation is unique. It may very well be the case that we should look at your credit. I would help you to fix it for free, give you some homework assignments to do. Let's maybe wait 30 days, 60 days, 90 days, and try to fix the credit. Once we get that, preferably above a 620, now we're really cooking with gas, because now when you're talking about the pricing of your loan, the pricing of your loan gets a lot better. It's much less expensive of a loan. You're going to get a better interest rate. You're going to get less closing costs. You're going to get lower payments because you're less risk. So number one, loan level pricing adjustment is your credit score. Number two is your debt to income ratio. What is a debt to income ratio? Very quickly, for those of you who don't know or you're not familiar with the term, the debt to income is just as it sounds. This is your monthly debt payments compared to your income, okay? Your monthly income. So let's say a quick example. Let's say that you make $3,000 a month and you have $3,000 a month in credit card payments and car payment, let's say, combined. Well, that means now that your debt to income ratio, okay, at least what we call your front end ratio, is 100%. That's very high. I would prefer that you guys have a debt to income ratio of less than 50%. If your debt to income ratio is less than 50%, this is another loan level pricing adjustment that can very much help you in terms of the pricing of your loan and the processing of your loan. Now, again, are there loan officers and mortgage brokers that are going to say, no, Aaron, they can get a loan if they have 56% or less? Yes, that's hypothetically true. If you have a debt to income ratio, what they call your back end ratio of less than 56%, then it's possible that you can get an FHA loan. However, I would say that we should plant a flag there, because if all of the other things in your profile don't line up, then it might be better to say, hold on, let's try to figure out another way so that we can get you a loan that doesn't stress you out, doesn't put you right up against the wall.
Yes, indeed. They've got the flag up now, and you can see the stars and stripes on the lunar surface.
Why put yourself in a bad position and set yourself up for potential stress, anxiety, failure when you don't have to? We could say, let's get a cosigner. Let's have someone help you put more down with the gift funds. Let's buy a less expensive house. There's many different options, and every single situation is like DNA.
A DNA strand like me is a blueprint for building a living thing.
It's very unique. So we have to ask lots of questions. I have to get the full picture. I have to paint that picture on the wall. And I have to say, okay, now, like a puzzle piece, I have to take your puzzle piece and try to fit it with the right loan type and the right lender type, to make sure that we're not trying to just cram something in there and make it work, right? Because it's good for me, but not good for you. And the opposite, I want it to be good for you. Doesn't matter if it's good for me. So I would like to see, again, your debt to income ratio lower than 50%, and preferably, if possible, lower than 40%, because that would mean that you get into your house, you're able to make your mortgage payments on time, and there's very little stress. If a speed bump in the road financially happens, you're not too worried. Number 3, loan to value. Loan to value affects the price of your loan because it pertains to how much money you put down on the loan. So the loan to the value is just as it sounds. It's the loan amount compared to the value of the home. Let's say that you decide that you're going to put only 3.5% down, which would be basically an FHA loan. Okay, great. And you can do that. That's definitely very possible. What that means, though, is that now you're going to have something that's an extra payment. It's called mortgage insurance, also known as private mortgage insurance, or PMI. Is that the worst thing in the world? No, it isn't. And for some people, it's a good idea as long as all the other things in your profile are lining up, so we're not in a stressful situation, okay? However, my preference for my clients, if possible, is that you put 20% down or more. Why is that? Number one, it's because you get to eliminate that extra payment. It could be $100, could be $200, could be $300 a month or more for a private mortgage insurance payment. So it saves you money. Number two is, of course, the payment itself is even lower because now you're putting more down. So you've got twice the reason to have lower payments there, less stress. And then also number three is that when you put the 20% down, it's less risk. You now have more skin in the game. So the lender's likely to give you better loan pricing. So if possible, again, using gift funds or something else, try to see if you can put 20% down as opposed to only 3.5%. Now, I realize for many of you out there, it's not possible. That's okay. Okay, we can have that conversation, but let's make sure again that we're not putting you in a bad financial place where you're one step from an emergency. My mother used to always say, always have a pad. Always have a pad, because speed bumps in the road of life financially happen. As a matter of fact, many of you watching this right now, you'll know what I'm saying is true. Every year, something in your life happens financially where you have to spend money that you did not anticipate. So it's good to have those reserve funds, as we call them in mortgage, so that you're not in a high stress, high anxiety situation when those things occur. Preparation, okay? Preparation, extremely important in mortgage. All right, a couple more. Number 4, the loan amount. This one isn't necessarily gigantic, but it's important to keep in mind. Your loan amount, or how much you're borrowing, affects the cost and price of your loan. And this is because when a lender lends you money, they're looking at how much the potential investment return is. So if they're lending you, let's say $1 million, they stand to make a lot more interest on that loan than they would if it's only $100,000. Now, the reason I say this isn't a gigantic one is because it shouldn't necessarily scare you away from getting a home loan. If you're going to borrow $150,000 or $200,000 or something versus $1 million, okay, fine. It might be slightly more expensive. But just keep in mind, if you're out there shopping online and you're looking at interest rates or you're looking at mortgage loan calculators, a lot of people come to me and they say, hey, Aaron, I saw these mortgage loan calculator on Zillow or on Realtor or Redfin or something like that, some other website. Many of those websites are in the calculation, in the automatic calculations on the back end of that calculator. They're going to make a lot of assumptions. And usually those assumptions are assuming a perfect situation, that you're a perfect top A borrower. You've got 740 FICO score, your debt to income ratio is super low, your credit score is super low. So then when you call me and we have a conversation, you go, gosh, Aaron, why are my numbers different than I saw on Zillow? It's like, well, that's why. Because we're not making all those same assumptions. We're having an accurate picture of what your financial situation is and what you would qualify for. So just keep this in mind. The loan amount that you borrow can affect the pricing as well by different varying degrees per different lenders. And the last one, number 5, is loan type. Different loan types have different types of risk associated with them. One example of that is a DSCR loan. DSCR stands for Debt Service Coverage Ratio Loan. That loan is designed for real estate investors who don't necessarily want to buy a primary residence where they're going to live. They're looking to potentially buy a property where, say, there's already renters living there. That type of loan doesn't look at personal credit. What the DSCR loan looks at is the ratio between how much you're getting in rents versus the market rents that are calculated for that area. It also takes into account the credit score of the borrowers, and it takes into account how much they're putting down, which is required by the lender. Now, because those loans typically have a higher risk, they are also associated with higher interest rates. Typically, on average right now in 2023, we're talking between 2 to 4 points or interest rate points higher than, let's say, a conventional or FHA loan. So just know that when you are thinking about getting a loan, the type of loan that you are thinking about getting also affects the price. Okay, that's it for today. Those are the 5 things that you should know when you're getting a loan because they pertain to how expensive your loan is, also called LLPAs. Keep your loan logical and call me if you guys need help. Take care.